Your safest account may be the one quietly raising your tax bill. In 2026, the retirement danger that catches careful people is not always the stock market, a risky private investment, or some strange digital coin a family member keeps recommending. It can be the ordinary checking account, savings account, certificate of deposit, or high-yield account at the bank you have trusted for decades. The problem is not that the bank is failing. The problem is not that your money is uninsured. The problem is that the interest can travel from your bank statement into your tax return, then into the formula that decides how much of your Social Security is taxable, and then into the income number Medicare uses to decide whether you pay higher premiums. A rate that looks wonderful on a mailer can become far less impressive once taxes and Medicare rules touch it. And for some retirees, the difference between a smart cash reserve and an expensive income trap is only a few $1,000s of interest. This is not a message telling you to fear banks or empty your savings account. Retirees need cash. Cash pays property taxes, medical deductibles, home repairs, family emergencies, and the monthly bills that do not wait for markets to recover. The point is different. After you retire, cash must be managed as part of your income system, not as a separate pile of safe money. Bank interest is ordinary income. It is reported to the IRS. It can affect calculations that were never explained when the account was opened. So before chasing any rate, you need to know your personal breaking point, the balance at which interest stops being harmless and begins changing your Social Security taxation, your Medicare premium risk, and your after-tax return. Use this information as education only, then take your real numbers to a qualified CPA or fee-only fiduciary before making decisions. Think about a 72-year-old retiree who did exactly what most people would call responsible. She worked for decades, avoided speculation, and entered retirement with a small pension, Social Security, a traditional IRA, and a large cash balance. Her Social Security benefit is $22,800 a year. Her pension is $18,000. She receives $2,400 in taxable dividends from a small inherited fund. She also has $340,000 in a traditional IRA and $215,000 in a high-yield savings account, paying 4.8%. She moved the cash after the bank sent a promotional offer promising far more interest than her old savings account. Nothing about that decision felt risky. The money stayed at a familiar institution. The balance was easy to see. The rate looked attractive. She believed she had upgraded her savings without changing her retirement plan. In reality, she changed her tax picture immediately. That high-yield account produces $10,320 of annual interest. The bank reports that interest on Form 1099-INT, and it shows up on the federal return as ordinary income. It is not treated like long-term capital gains. It is not treated like qualified dividends. It is simply added to the income stack. On its own, that already matters because ordinary income is taxed at the retiree's marginal rate. But the bigger problem is what happens next. The same interest can increase what the IRS calls provisional income, which is the number used to calculate the taxable portion of Social Security. The simplified formula is adjusted gross income plus tax-exempt interest plus 1/2 of annual Social Security benefits. Once that number crosses certain thresholds, more of the Social Security check can be pulled onto the tax return. For Social Security taxation, the key federal thresholds are old and surprisingly low. For a single filer, the important numbers are $25,000 and $34,000 of provisional income. For a married couple filing jointly, they are $32,000 and $44,000. Below the lower number, benefits may not be federally taxable. Between the two numbers, part of the benefit becomes taxable. Above the higher number, the formula can cause up to 85% of benefits to be included in taxable income. It is important to say up to because crossing a threshold does not instantly tax the entire benefit at that percentage. The taxable amount phases in through a formula, but the effect is still powerful, because $1 of bank interest can create more than $1 of taxable income when it causes additional Social Security to be included. Before the high-yield account produced that extra interest, the retiree's provisional income was already close to the upper line. She had $18,000 of pension income and $2,400 of dividends, giving her $20,400 of non-Social Security income. Half of her $22,800 Social Security benefit is $11,400. Add those together, and her provisional income was $31,800. That placed her above the lower single-filer threshold, but below the $34,000 upper threshold. Under the actual formula, about $3,400 of her Social Security would be taxable. That is not ideal, but it is manageable. She still had roughly $2,200 of room before crossing the upper threshold. A person looking only at her bank balance would never see how thin that cushion was. Now add the $10,320 of bank interest. Her non-Social Security income rises from $20,400 to $30,720. Add the same $11,400, which is one-half of her Social Security benefit, and provisional income jumps to $42,120. She is no longer slightly below the upper threshold. She is well above it. The taxable portion of her Social Security rises from roughly $3,400 to about $11,400. In other words, the interest did not only create $10,320 of taxable interest, it also caused roughly $8,000 more of her Social Security to become taxable. That is the hidden part. The bank statement shows the interest. The 1099 shows the interest. But no form arrives in the mail saying, this interest also changed the Social Security formula. If her combined marginal tax rate on the affected income is around 26%, the direct tax on $10,320 of interest could be about $2,700. The tax on the extra $8,000 of taxable Social Security could add roughly $2,100 more, depending on state rules and the exact federal bracket. Together, that is close to $4,800 of tax drag connected to a savings account that advertised $10,320 of interest. Her real improvement may still be positive, but it is not the number she thought she was earning. A 4.8% yield may feel like 4.8% on the bank website, while the usable result after interactions feels closer to half that. This is why retirees cannot judge cash only by APY. They must judge it by after-tax, after-benefit, after-premium impact. The second issue is Medicare. Higher-income Medicare beneficiaries can pay an income-related monthly adjustment amount, commonly called IRMAA, for Part B and Part D. Medicare generally looks back to a prior tax return, often 2 years earlier, and uses modified adjusted gross income to set those premiums. That means income created in 2026 can influence future Medicare costs. A retiree may look at current premiums and assume everything is fine, but the tax return being built today may be used later. Bank interest is included in that income picture. It may not push someone over an IRMAA bracket by itself, especially if that person is far below the line, but it reduces the space under the line. It becomes recurring background income sitting underneath pensions, IRA withdrawals, dividends, Roth conversions, capital gains, home sales, and any other taxable event that might happen later. Required minimum distributions make this even more important. A traditional IRA does not stay quiet forever. Once RMDs begin, taxable withdrawals can arrive every year, whether the retiree needs the money or not. A $340,000 IRA can easily create a first required distribution in the range of $12,000 to $13,000, depending on the account balance, age, and IRS table. Add that to the pension, dividends, bank interest, and taxable Social Security, and the income picture changes fast. The high-yield account may have looked harmless before RMDs began, but once required withdrawals start, the same interest can become the extra weight that reduces Medicare flexibility. It can also limit room for planned Roth conversions, charitable strategies, or one-time cash needs. The issue is not one bad year. The issue is recurring income that appears automatically every year. There is another bank-related rule retirees should understand, but it must be handled carefully. Under the Bank Secrecy Act, financial institutions file a currency transaction report for cash transactions over $10,000 in a business day. This is about physical cash, not ordinary electronic transfers, direct deposits, checks, or normal wires. A currency transaction report is not an accusation. It is routine compliance, and honest people with legitimate money should not panic about it. The real danger is structuring, which means intentionally breaking cash transactions into smaller amounts to avoid a reporting threshold. If someone says, "Take out $9,500 so it does not get reported," that is the wrong advice. Do not choose transaction amounts based on avoiding a report. Use the amount you actually need, keep records, and consider traceable payment methods when practical. Transparency is safer than trying to appear invisible. Retirees need this reminder because large money movements often happen late in life. A home is sold, a rental property is closed, an inheritance arrives, a spouse passes away, an adult child needs help with a roof, a medical bill, or a down payment. Suddenly, someone who usually handles small monthly transactions is moving meaningful cash. That is when casual advice can become dangerous. The correct response to bank reporting rules is not fear. It is documentation and honesty. If a transaction is legitimate, let the reporting system do what it does. What you should never do is split withdrawals or deposits for the purpose of avoiding a threshold. That can create a legal issue where no financial issue existed before. Now step back and look at the incentive structure. The bank wants deposits. The more money customers keep in deposit accounts, the more useful those balances become to the institution. A higher advertised rate can attract more money. That does not mean the bank is dishonest. It means the bank is selling a deposit product, not building your retirement income plan. Its promotion may be accurate and still incomplete. It can tell you the APY without modeling your Social Security taxation. It can send a 1099-INT without warning you about Medicare headroom. It can show a monthly interest credit without explaining your marginal tax rate. The bank sees the account. The IRS sees the return. Medicare sees modified adjusted gross income. You are the only person who has to live with all three. So, how do you find your personal limit? Start with your annual income before counting savings interest. Include pension income, part-time work, rental income, taxable dividends, IRA withdrawals, required minimum distributions, and any other recurring taxable income. Then add 1/2 of your projected annual Social Security benefit. The result is your provisional income baseline. If you are single, compare that number with $25,000 and $34,000. If you are married filing jointly, compare it with $32,000 and $44,000. If your baseline is below the next threshold, the gap is your Social Security headroom. Divide that gap by your savings rate expressed as a decimal. If you have $2,200 of room and the account pays 4.8%, divide $2,200 by 0.048. The answer is about $45,800. That is the approximate balance that produces enough interest to fill the remaining space. Now apply that to the retiree in our example. Her provisional income before bank interest was $31,800. The upper single filer threshold is $34,000, so her room was about $2,200. At 4.8%, only about $45,800 of savings would generate that much interest. But she had $215,000 in the account. That means roughly $169,000 was above the amount that fit neatly into her Social Security threshold space. That excess is not automatically wrong, and it should not be moved impulsively, but it deserves review because it is creating ordinary income every year. If she is already above the Social Security threshold in future years, the question becomes Medicare headroom, tax brackets, RMD pressure, and timing control. Do not hear this as a command to drain the bank. That would be reckless for many households. Retirement cash has a purpose. It protects you from selling investments during a bad market. It covers emergencies. It gives psychological comfort. The better approach is to divide money into categories. Keep true operating cash for monthly bills. Keep emergency cash for the expenses that would create stress if they appeared tomorrow. Then identify the excess cash that is not needed for near-term life. That excess is the money to discuss with a professional. The goal is not to eliminate interest. The goal is to stop accidental interest from controlling your tax return. A safe account can still be useful, but every dollar in it should have a reason to be there. Once excess cash is identified, there are several strategies to discuss. One is using outside cash to pay taxes on carefully sized Roth conversions, which may reduce future required minimum distributions and create more tax-free flexibility later. This must be modeled because the conversion itself increases income in the year it happens. Another option may be municipal bonds, especially for retirees in higher brackets, but they are not a magic shield. Tax-exempt interest can still count in the Social Security provisional income formula and may affect Medicare modified adjusted gross income. Some retirees consider Series 1 savings bonds, Treasury instruments, or laddered short-term securities, but interest timing and tax treatment matter. Others may review tax-deferred fixed annuities or multi-year guaranteed annuities, where interest can accumulate without a yearly 1099 until withdrawals begin. Those products have surrender periods, liquidity limits, insurer risk, and contract details, so they require careful review. There is no universal answer. The right tool depends on liquidity needs, health, state taxes, estate goals, risk tolerance, and the rest of the balance sheet. The deeper principle is income timing. Bank interest gives you very little control. It is earned, reported, and taxed each year. Traditional IRA money is taxable when withdrawn and eventually forced out through RMDs. Roth accounts may provide tax-free qualified withdrawals. Taxable brokerage accounts can create dividends and capital gains, but some gains can be timed. Deferred contracts may postpone income, but they may reduce flexibility. A strong retirement plan coordinates these buckets instead of treating each account as an island. The question is not simply, where can I get the highest safe yield? The question is, which account should create income this year? Which account should wait? And how will that choice affect Social Security, Medicare, and future taxes? Here is the action step for this week. Log into every bank account and find the year-to-date interest earned on checking, savings, money market, and certificate accounts. If you cannot find it, call and ask for it. Write down your pension, Social Security, dividends, IRA withdrawals, rental income, and any expected year-end income. Calculate provisional income before and after bank interest. Then estimate your modified adjusted gross income and compare it with the current Medicare IRMAA brackets for your filing status. If the numbers are close, schedule a tax planning meeting before year end, not after the forms arrive. Ask the professional to calculate your after-tax return, not just your APY. Ask how much cash truly needs to stay liquid. Ask whether any excess cash can be structured with better timing, lower tax drag, or a clearer long-term purpose. This matters because the Social Security taxation thresholds have not kept pace with modern retirement income. A retiree with a modest pension, a small IRA, and a careful savings habit may cross thresholds that were never adjusted the way everyday costs were. You do not have to feel wealthy to be affected. A normal household can be pulled into taxable Social Security simply because it has a pension, a required distribution, and a high-yield account. That is why the old advice to keep a large pile of cash at the bank and relax needs an update. Safety is not only about avoiding market losses. Safety is also about protecting cash flow from unnecessary taxes, surprise premiums, and income formulas that quietly change the result. The mistake many retirees make is evaluating every account separately. The savings account seems safe, the IRA seems separate, the pension seems fixed, and Medicare seems like a different subject entirely. But the government does not experience your money that way. It sees income lines feeding formulas. When one line gets bigger, another formula may react. That is why a small spreadsheet can be more valuable than another promotional rate. You do not need to become aggressive. You do not need to abandon safety. You need precision. You need to know which dollars are emergency dollars, which dollars are tax planning dollars, and which dollars are only sitting in the bank because nobody has given them a better assignment. Before this video ends, remember the main point. The account that looks safest may still need a strategy. Do not panic, do not rush, and do not let fear push you into a product you do not understand. Collect the numbers first. Find your interest earned. Run the provisional income calculation. Check your Medicare headroom. Protect the cash you truly need. Then review the excess with someone who sees the whole picture, not just the account balance. If the high-yield account still makes sense after taxes and Medicare effects, keep it with confidence. If it does not, redesign the plan while there is still time to influence the current year. Like this video if it helped, subscribe for more clear retirement breakdowns, and share it with one person who has a large savings balance but has never asked what the interest is doing to their Social Security. The bank can tell you the rate. Your tax return reveals the consequence. Your job is to connect those two before the calendar closes, because retirement security is built by people who know the rules before the bill arrives. SSA Insights Pro.